appreciate you being here. Thanks, Ross. Excellent job. And again, I'll type in that link one more time. It's bluetickresearch.com/ebook. So if you enjoyed what Ross just taught, you can download that ebook right there. And hope that you enjoy it. And we appreciate Ross being here, even though he's not feeling so well. Our next speaker is John Seville. John's actually, I believe, presenting from Australia today, and so we appreciate you doing that. I know it's nighttime there. Real quick, can everybody see the slideshow? It says profitable trades and targets. I want to make sure you guys can see the slideshow. Okay, good deal. If for some reason you cannot see the slideshow, try hitting F5. So we'll go ahead and, John, I'll turn things over to you. In the next hour and 15 minutes, the room is yours.
Thanks a lot, Morgan, and thanks, Ross, for that great intro. I certainly was a wonderful guy catching up with in Vegas, and you know what Ross does over there at Blue Tick is good stuff. So thanks so much for that, and thanks, Morgan, for the opportunity to come here tonight, or for this morning for you guys. Can anyone hear me okay in the room? Just a quick yes if you got the Australian accent coming thick and thin. Right. Yeah, well, it sounds like we've had a lot better weather in Australia than you've been having in the Northern Hemisphere, but I'll be joining you on Tuesday. But for this evening, what we'll be talking more about is, of course, profitable trades and targets, which is a specifically applicable going into 2014. I took great pleasure in listening to Ross talk about the 5 million% that Buffett's been able to accumulate over the last 40 years, and how they must know something, and you know, and that's just so true. And for the value investing out there, it's imperative to tap into what are those things that the fundamental guys are doing. And for my talk this afternoon, or excuse me, this evening, this morning, I'm going to be talking about the other side of the market. I'm going to be talking about the money that moves in a different way, not through the long-term decision making, but the split-second decision-making that happens millions of times a day, which we've come to know as high-frequency trading. And we're going to talk about the role that plays in the market, and how we can benefit from it. But before we get too carried away, standard disclaimer, you'll probably see many of these through this 24-hour Trade-A-Thon. So I won't bore you too much with that, but of course, it just means that trading obviously does involve risk, and that's nothing new I'm going to teach you tonight. But obviously do take care in choosing your stocks and strategies, and consult a financial advisor. Okay, so quick introduction to Acorn. For those of you who don't know us, I see a lot of familiar faces in here today, but for those of you who don't know us, we were founded back in 2007. It was just myself and a small group of traders originally that focused mostly on technicals, and we saw a very great change in the market over the previous years, where fundamentals obviously still playing a very important role. However, the volatility was becoming more and more prevalent. And I remember one particular stock I watched going from 6 to 10, 6 to 10, 6 to 10, and nothing changing within the fundamentals. And of course, that started to tweak our interest in what opportunity lay there. In June 6, 2008, we alerted we had about 100 students we were working with at that time to the smart money giving us big signals that they were pulling out of the market. And that really was what launched our business into what it is today. So we saw that coming, and using those same indicators, we actually alerted ourselves to the EU crisis in 2010, and we've been getting some interesting signals recently. So I'll be talking about what those were and what those are now as we go through this presentation. But of course, let's start with where we're at in the world. Apart from the extreme cold fronts we're seeing, we've got some other big problems. We've got central banks that have been pumping money into the economy with no end in sight. We've got, as Ross said, you know, ultimate optimism amongst all the players. You know, so is this market activity based on true economic activity or just another bubble? Of course, all-time highs on the S&P 500. I remember reading in Stock Twits that there was something like over 95% of the sentiment was bullish going into 2014. That scares me. So those are some of the things that we're looking at. Of course, some of the other questions, where has a lot of this value come from? Well, a lot of the values come from technologies like cloud computing, the Yelp, the Amazons, the things like Tesla that have rallied on massive P/E ratios on tiny sales. Some intangible types of growth, which is hard to put your finger on. So again, is this a bubble? And what is your plan going into 2014? What's your best case plan? And what's your worst case plan? So if things really kind of go to hell in a handbasket, how are you prepared to protect yourself? Again, don't lose money like Buffett says, but more importantly as well, how are you going to benefit from it? And let's flip that around. What if things go great? What areas are you looking for there? So, for example, just a plan could be, hey, if things go to hell in a handbasket, we might be looking at the housing sector for shorts. If things go great, what are the sectors you look for there? So again, talking about having these plans is also something that I'm going to be focusing on as we go through today. So I always like to ask this question very quickly. What type of investors are most of us in the room? We have a great sized room here, so I'm sure it's very diverse. I know we have a lot of day traders in here, but if you were to pick one, what are most people's general preference here? Swing trading, day trading, long term? We've got the familiar face here that Ross was chatting about. I generally like to think of swing trading. It's a very broad term, but I like to think of swing trading to be anything from a 3-day hold to a 3-week hold, but sometimes it could be a 3-hour. But how we can set and forget. So we basically have a plan that we formulate while the market is closed, and we talk about areas we want to buy and areas we want to sell. That's how I classify swing trading. I don't care how long it takes, but it's more the set and forget type of strategy. Day trading, more so watching the strategy unfold and acting on it. Okay, so a lot of swingers here. Billy, not a swinger. Okay. Austin Powers. All right. A lot of swing traders and day traders. Okay, that's terrific. So hopefully you'll find this this quite valuable, because it really does associate with those types of tactics. So the next question. I mean, these are the kind of general cliche terms you see in any financial presentation. You got the grandfather kissing his kids and things. But I do like to ask this because it gets people thinking again. What's your trading style? But what are you doing it for? Because often it's not just to make money. It's got to fit with your lifestyle. Because if you're trading in order to spend time with family or travel, well, I can tell you it's very difficult to day trade if it's 3 o'clock in the morning when the best time is to trade. So, you've got to think of a trading strategy that meets your lifestyle. For me, I pick swing trading as one of my favorite strategies because it does allow me to travel. I probably make a little less than if I was can you make more money in less time? You got to think of that equation. Anyway, we'll talk more about that as we go on. More importantly, what I want to ask is, how do you make your decisions? So, and this is of course, the focus of tonight in terms of building profitable scans and profitable patterns. How do most people here generally start their trading decision off? So if we were to sit down together and I said, tell me exactly what you're looking for to buy a stock tomorrow or today, how would you start that process off? So most people are news. I see fundamentals, mostly technical analysis. Okay, so the examples, as you can see here: news, friends, newsletters and brokers, things you're familiar with. This is a photo of Vancouver. You can actually see my office just above the little white building there. Is where we usually work out of. I see a lot of supply and demand. Okay, Gregory, yeah, we'll be talking about that. So most people's decision making when you look at the market is usually based on emotion, which always leads to mistakes. So failing to limit losses, averaging down, all those types of things. And this is perhaps why 95% of investors lose their money, because they're investing emotionally and they lack a strategy. So, and how do we get distracted? How do we get sucked? All of this noise. So no matter how good our strategies are, I've seen great traders get the hero complexes because they think anything they touch will turn to gold. I've also seen people be frozen by fear, traders with great strategies who've got into a hole because of this type of stuff. So the question that I would pose to you, because I saw a lot of people talking about the fact they make their decisions using technical analysis, I pose a question back to you. Well, what exactly though? If I were to give you a pen and paper and you were to draw exactly what that chart would look like, what would it be? What exactly would the candlestick look like? What exactly would the support look like? What chart pattern would it be? How much volume would there be? What pivot point would you be hitting? All those types of things. What would the short float be? You can then get into things such as Ross was talking about, the P to E ratio, price to book ratio, sector, insider buying, institutional buying. You've got this checklist. And I'd like to make the analogy of if you were going out to buy a car, and I think even Ross has talked about this in the past. If you're going out to, and you know, we've got 2 kids, so we need a 5-seater. They like to go skiing on the weekends, so we'll need roof racks. Okay, it's snowy and cold outside, so we'll need snow tires. And you go out with a $30,000 budget to go get this car. How impressed do you think your wife would be, or your husband, if you came back with a 2-seater sports car with slicks on it? Not real great, right? So just like we go out with a checklist when we make normal purchases with price ranges attached, we should be doing the exact same thing with our money. But we should be having a plan and a checklist and be knowing exactly what we're looking for and checking those boxes off. So most people don't have that, and that's why most people aren't going anywhere. And this is what we're trying to accomplish when we, as we talk about the strategies going forward now, is how exactly what that list should be. So I see a comment there. Technicals don't mean much in today's market, do they? Well, I'd argue that they do. In fact, a very, very important role. Because let's ask a couple of key questions. Who controls the market? Who controls the market? Well, a broad statement we can all agree on is volume controls the market. Volume dictates price. So if volume dictates price, volume. Supply and demand, yes. Institutions, exactly. The banks worldwide, sure. And why don't we give this group of people a broader term, the smart money. The smart money is mostly represented usually by the 4 big ones, JP Morgan and Goldman Sachs being the 2 better known. But these market makers, these smart money that have these this influence over the market, we generally term the smart money. Okay, now if you start looking at some of the statistics gathered over the last few years, they estimate that now 70 to 80% of all of the trades done each day are done by computers. And that's not people sitting at a computer like you and I might do, program, it's buying and selling. This is computers buying and selling based purely on rules and formulas that they've been programmed into them. So these are basically bots that make automated trading decisions. Now, often people ask me, well, John, does that mean that Goldman Sachs or these computers own 70 to 80% of the money? And the answer, of course, is no, they don't. But let me pose it to you this way. If you're a trader and you've got $1,000 and you buy and hold a stock with $1,000, you would represent $1,000 worth of volume. If 100 people stock, that would represent 100,000 volume. Okay? So 100 people with $1,000 represents 100,000 volume. Now let me pose this to you. If that individual trader, one of those traders, bought and sold, how much does he now represent, he or she? He buys and sells in the same day. About $2,000 of volume, exactly. Okay, now let's say that they do that 100 times. Now that trader represents $200,000 of volume. So with $1,000, that trader has represented 200% more money than 100 traders with 1,000. Okay, and this death by 1,000 cuts is essentially how high-frequency trading is being able to account for such a large level of the volume in the market. So again, the next thing that people then say is, well, geez, John, if that's the case, how do I even stand a chance against such a dominable force? Well, we're not trying to compete against these guys. What we're trying to do is to recognize that these guys are making billions of dollars a day, right, consistently. So what we want to try and do is mimic the waves and the methods that they buy and kind of be like the flea on the elephant's back. We just want to jump on and take a little chunk of that profit and get out. Because these forces are very, very powerful. May 620 flash crashed, 1,000 points down, and then magically hit some kind of invisible floor and went straight back up, right? So how valuable would it have been to know where that floor was? That was pure algorithms. How valuable would it have been to know where that turning point was? Because I would argue that you can figure that out, and that's what we specialize in. So when something happens again and again and again at the levels of volume that this occurs at, these forces are reverse engineerable. Because they're following the same rules. The trick, or let me put it a different way, the reason why most people are unsuccessful at doing this is because they try and focus on the market as a whole. They try and reverse engineer the entire market, which is impossible. There are hundreds of different patterns out there that this smart money utilizes to trade. So trying to be good at all of that and be a general practitioner in the market is like trying to be a doctor specializing in every type of medicine. It's a terrible idea. Just like you wouldn't eat at a restaurant that has 100 different entrees. Probably terrible food. Okay, although having said that, I did have an experience like that recently. So anyway, the trick is to specialize. So how do we specialize? Where do we think the high value specialization is? Well, let's firstly start with another few true statements before we get into the intricacies here. Firstly, let's keep in mind that in general, a stock or index generally will always change direction because it has hit one of a few things. Either horizontal support and resistance, trend line resistance, or moving averages. Right? If we can understand this principle, almost every other trading strategy that I've traded with anyway builds off of this. So essentially what I'm getting at is algorithm. Oh, sorry guys, I bumped the mute button. Can you hear me okay? All right, terrific. So let me just backtrack a second. What I was saying, a wallaby ate my baby, that's right. What I'm saying here is that essentially, let's just go back a little. algorithms do not see this. They don't see charts. They don't see the fancy indicators. They don't read the, well, some of them read the news, but most important, ones and zeros, buys and sells. And if you want to take trading down to an extremely simple idea, the key way to make money easily, or simply at least, is to be able to understand where these levels are at, and simply buy when a stock hits one, and sell before it hits the next. Because between here and here, between one of these levels, there's nothing there to stop it. The trick is understanding where these levels are. And the trick is understanding where the strongest level is. Because if there's 1, 2, 3, 4, 5 different levels, some of these might be short-term stopping points, but there'll be one that's a high probability turning point. And that's what we want to focus on. Because that's where these millions, if not billions of dollars are sitting there. And if we can catch onto that fingerprint of where they do that, now we're onto something. So let's take this a step further. Again, look at the flash crash of 2010. Voodoo lines. That's right. So here's the flash crash. So we were talking about how valuable it would have been to know where that turning point was. Well, we should have known that, because we could see back in February of 2010, the market already had quite a nasty slip. And that is exactly where it turned around after plunging over those couple of weeks and went straight up from around that 1060 zone. And sure enough, formed the base of support at 1180 and then crashed all the way down to that exact same point, touching on it and then bouncing back up like an elastic band, snapping back into place. We then reached the top, and then we saw this same movement play out almost exactly the same. So the key okay. So let's have a look at how we actually can do that. Let's have a look at what we define as where these levels are. Okay, I'm going to bring out my pen here. All right, so the first trick, I just throw it back to you. What do you think would be the signs of true smart money buying? If we're looking for the fingerprint of the smart money, the evidence that the automated buying is happening, what do you think you'd be looking for in that fingerprint? Anyone want to take some guesses? Yeah, Fibonacci levels can definitely be areas to look for. High volume, thank you, Philip. Exactly. Down, we bounced. We want to see a nice big bar of volume as well. Let's just excuse my drawing. Okay. What else do we need? Any other guesses? I'll give you a couple of ideas. The first thing we want to see when we come down and bounce is we want to think about what we're trying to create. And I really stress the importance of this. Forget all the fancy names that you hear, you know, spinning tops, doji bars, haramis, hammer candles, whiz bang, blah, blah, percent KYW. Forget all of that. Think about the basics of what actually moves stuff in the market. Okay? So if we're going to reverse engineer and think about the why, if we're thinking about algorithmic buying, how does algorithms buy? They buy like the flash crash, straight away. Because a value gets hit, something happens. A value gets hit, something else happens. So if we're looking for the fingerprint, surely we should be looking for an aggressive bounce, something that goes straight up. Evidence of a fingerprint, we want to see a stock that's rallied down, hit a level, and when it hit that level had a very aggressive reactive bounce on big volume. The next thing we want to see is we want to see that it went up a lot. Because if a fund or a smart money or whoever it is buying with 5, 10, 15, $20 million or 20 million shares even, it's not going to be getting in and out for 10 cents. It's going to be looking for a reasonable move. So we're going to be looking for it to be probably acquiring a position through this first level and exiting its position over the last level, taking that chunk in the middle. So a big move also constitutes evidence of a real big player move. Okay, the next thing and final thing we want to look for is how frequent that level has been hit. So a quick test of the audience, if everyone wants to just throw their hat in the ring here, what do you think is better? To see a stock, if you're looking at a stock, let's say it's at $10 and it's bounced off $10 5 times, what's better? That it's bounced off at 5 times and never gone below 10, or that it's only bounced off 10 once? Which would you prefer? Let's call this 10 bucks. Isn't that great? I love the diversity. This is what makes trading and teaching so interesting. I'd say 1. Now let me tell you a quick thing. When I first started trading, I said 5 times. In fact, I say 10 times. The more times, the better. Because the more times it's hit it, obviously the stronger it is. But not so. Think of a football game. If you're watching the Cardinals play the Rangers, and I saw my first Cardinals game in 2013, it was great, my first football game. And I remember sitting there watching it, and to begin with thinking, wow, this is chaos. You know, these two teams, all these big blokes running like chaos, like madmen across the field at each other. How does this game work? And I sat there and sipped on my beer and thought, geez, I can see why people get into this. But the more and more I watched it, the more I realized it was a very orchestrated play. And as I started seeing some similar throws being thrown, like the Hail Mary, I noticed that the exact same type of movement would occur. But it was hard to pick out because there were so many different plays. So think about the terms of the stock market. The market makers, the smart money, are like the coaches on either side, and they have this playbook of hundreds of patterns to play out in a stock. Now, if the coach kept playing the same exact play again and again and again, what would happen? It would stop working. It would be easier to defend against. So the market is not there to help you make money. The market is there to make money from you, to take your money. So as soon as something's been hit once, twice, 3 times, to me, that's useless. That's called the rule of 3. Think about it. How many times have you seen ascending triangle? 1, 2, 3. Breakout. Rule of 3. Write that down. It's one of the most valuable things that I ever taught myself. So when this is the checklist. When we're looking for the smart money, we want sharp reversals, fresh reversals, so ideally only if hit once, and we want to have it rally a fair bit. Okay, so let's move forward. Here's your test. If this was an option, if we got 4 different potential trades here that we could make, which would you want to buy? Would you want to short at A next time it hits A? Would you short it next time it hits B? Would you buy it next time it hits C? Or would you buy it next time it hit D? What would you think would be the ideal trade, hypothetically, if this was a stock, a chart? You guys are awesome. This is actually probably the 4th time that I've ever taught this topic in this type of a format, and this is the most impressive answer I've had. It is D. Very well done. Either I'm explaining it well, or you guys are just really intelligent. Okay, so it must be the latter. It is D, because you can see that D rallied the longest. It's also the fresher than C and B. C and B have already hit once, twice, and now a 3rd time. whereas D has only bounced once and it went up 1, 2, 3 levels. And with A, almost as good because it is also fresh but only went down 2. Now, a lot of people often choose B and C, however, because of what I call the FOMO disease. The FOMO disease. And the FOMO disease stands for the fear of missing out. Most people say, well, yeah, D would be great, but what if it never hits D? Well, that's emotion. That's the fear of missing out that makes you take a trade that isn't the price you want because you're afraid that it will never get there. And that is pure emotion. So we want to avoid that. We want to wait for when those ideal trades happen. And that's why we want scans, because instead of you being afraid of missing out on that great trade on that stock that you've been watching for 6 months, you get rid of that and start scanning for stocks that are at D today. Okay, so next test. Based on what we've just talked about, let's flip it around. Let's say we have two identical side by side. We're looking for a short for tomorrow. Which would you prefer to short, A or B? Exactly, yep, I'd go B as well. Because if you look at A has a higher low, meaning that the buyers weren't waiting for it to get as low. They bought it early. They're eager. Secondly, if you have a quick look, you'll see that this is not algorithmic selling. This is not a high probability sell zone. This is if I can use the term, the mums and dads of the world. And we're all mums and dads of the world, but you know what I mean. This is the retail trader selling. This is the algorithms holding and building a position. Okay? This is what we want. We want B. Okay. So let's continue pushing through. So looking for the smart money. In order to move the market or to change the direction of a massive move, the smart money has to agree. So no matter if you're right, let's say you find the diamond in the rough, unless the smart money agrees with you, it won't go anywhere. So you could do all the research in the world, and you could be great at doing that, and you could find a stock at $10 that in 2 years' time is $40. Let's say it does go to 40. But let's say that the smart money, it's trying to make a huge return like the smart money does because it's a capitalist, you know what, it likes to make money. The best thing that the smart money can do is push that $10 stock down to 2 because it makes a lot more from 2 to 40 than from 10 to 40. So you buy it at 10 because you're right, it is a good company, but it doesn't start going up until it goes all the way down to 2 first. Well, that's a tough and painful ride. So wouldn't it be more valuable to have that great idea but know how to time it by recognizing the fingerprint of when the smart money is getting in? So this is what the importance of this slide's all about. So checklist. This is what we just talked about. So we're going a little bit backwards here, but that's okay. You know, everything goes backwards in Australia. High probability zones, previous strong levels of buying, fresh levels, powerful levels. There's your checklist. And the stocks we want to be doing that on is we want to be doing it on this stuff. We want to be doing it on your correlating trades with the market. So if the market is rallying into one of those levels, we look for shorts. So we go contrarian. Markets rallied, we look for shorts. Markets dropped heavily like it did last week, we look for longs. Then we look for correlating trades with sectors. Again, we're not looking at what has happened. So many people say, oh, John, tech has been the most bullish sector for the last month, so I'm concentrating on tech. And I pull up tech and say, well, hang on a second, it's just going into a seriously strong resistance level. So again, try to anticipate based on seeing the rotation, what's next versus what has happened. But if you can put all this together, you've got a very powerful formula or recipe. Here's an example. This is just a chart I'd like to bring up that came up. It's around $30. You can't see the price on the right here, but this is about $30. You can see the Chicago Board Options Exchange rallying hard from up around below, I think it was around $20, 18, straight up, hit that zone, and then went straight down. The second it hit it, straight down. Rallied up again, made a lower high, straight down again, similar level to it dropped to. So anyway, we didn't trade this back here, but what we did do is we saw this, and as the stock was rallying, as the index was rallying up to this same level, at the swing trader in me had the set and forget. Right, if that hits that again, that zone, that's an easy short. That makes total sense to me, and I'd do that trade 100 times over and over again if I could. So as it popped into there, that met all of our short criteria. Here, what happened next? We push forward. There you go. Nice big drop. Now, I'm not a greedy trader. I look at it this way. I think that the further you stretch an elastic band, the higher the probability it will snap. So with that in mind, I like to take what I call the easy money. I just want to get in and out, make 6, 7, 8%, try and do that over a week or two, and I'm out. That's the highest probability zone of the profit. So if I want to make 20%, that's my goal. I prefer to do that trading 2 lots of 8% compounded versus trying to hold for a full 20. That just makes sense to me. And if I want to make more, if I want to get really aggressive, then I'll high probability trades versus trying to squeeze more out of the stone. So there's that example. We'll talk about some. I'm going to talk about some live examples. I think we're going to have time, which is great. So I'll be talking about things like Facebook, BlackBerry. I saw someone in the previous presentation mentioning ETRM. That's pretty cool because we just picked that just the other week as along. So we'll talk about a couple of those things. Apple. So we'll get around, but the final thing we want to do once we've got these checklists is we then want to look at our indicators, and this is when we use indicators. Once we know what we're looking for, now indicators can be valuable, not the other way around. I see that people do that all the time. They scan using indicators, they follow the indicator like it's a Bible, and it always usually ends in tears. Indicators are only there to confirm what you already see in the chart. So you need to know what the recipe is that you're using for the indicator to work. And if you do, they can work very, very well. So we'll be looking for overbought and oversold indicators. We'll be looking at Bollinger Bands. We'll be looking at basically things, if we're looking for a reversal trade, that show us this stock is really out of its depth and is likely for a pullback. And what's even better, as we've been talking about, is seeing that the smart money agrees and it's been selling it for the last several weeks as it rallies. And there again is your powerful recipe. The final checkpoint as we go into developing this scan or this strategy out is we then can increase the probability using charting patterns, understanding the importance of things like we discussed before, that whether it's higher highs or lower lows, is the range contracting, is the range expanding? And there's about 100 odd of these patterns. Very tough to be an expert at all. And what I'd encourage you to do, and what we do, is we specialize in a few. So while we might recognize a lot of them, we trade the selective few that are the highest probability. These are great. Flags are great. Scallops are great. Those are some of my favorites, and those are the ones that I predominantly stick to. There's your checklist again, anyone who missed it. So, but finally, the most important clue of all, the difference in being able to differentiate between a double top that does this versus a double top it does this, or in other words, the difference between a win and a loss is understanding where the smart money is going. Because a company just won't break through with any significance if the smart money is not behind it. And this is where this really becomes important. So is the smart money seeing the flood, as you can see in my Noah's Ark example here, or are they going with you? Question, what is a scallop? You mentioned flags and wedges. A scallop, okay, real quickly, scallop basically what that is something that looks a little bit like, look here, looks a bit like this. Highly profitable, looks a bit like this. You know what? Let's see if you can see this. Everyone see my whiteboard? This is a scallop. It's basically where you get a stock. Whoop. Basically where you get a stock that essentially looks like this. Basically had a big drop way below, and it has to look like this nice big kind of ski jump type of bottom, and then it does a little kicker at the end like a hockey stick or a ski jump, and that is what I made my career on. It's the only thing I traded for 4 years. And by the way, in 2008, trading these types of things, I found 220 stocks in the scallop scan, or what I call, self-called a fallen angel. And out of 220 stocks picked long in 2008, I think it was somewhere between 70 and 72%. I think the worst month was 65 and the best was 80 in terms of how many went up versus down in that scan. And that's long picks in a short market. These work very, very, very well in all different conditions. You can research these, but there you go. That's what that is. Okay, let's go back to our. We can talk a bit more about that later. Let's continue on. So coming back to smart money. Smart money is key because this is what will give us the true probability. I don't have the time, nor do I want to compete with the research that the smart money can do, or their resources. So understanding the signs of how they make decisions can be just as valuable as doing that research yourself, or a great combination to doing it yourself. And understanding those probabilities is what will ultimately tip the balance in your favor. Without that strategy, you are constantly changing variables. Think of this. Why do lotto people, well, I think you call it the lottery. It's called the lotto in Australia. Why do you think lottery winners go broke? Because they have a big win, but they've never figured out the decision-making processes to continue making money. They've only made bad decisions a lot of the time, so they continue making bad decisions, and that big win soon becomes nothing. As traders, that's called wiping out or blowing up. And then you have a couple wins, and you change your decision-making. The thing is if you have a big win and you don't know how to replicate it, you're headed for disaster. And if you have a big loss and you don't know how to avoid it or what you did wrong, then it really is a loss because you've learned nothing from it. The thing is, you have to have a consistent set of variables where you understand why you put those variables in place in the first place to be able to build a strategy from. So you can say, if I tweak this, what happens? The problem is that takes tens of thousands of hours to do properly. And most people don't have that time, but this is the key that you need to understand, is that without those consistency, it's impossible to make a career or even a part-time career out of trading profitably, which I think is probably what we all want to do. We all want to make money. Again, so think of ideas of being efficient. I'd like to challenge you on this. My economics professor used to ask me this, and it was in the 4-Hour Work Week as well by Tim Ferriss. He says, who's the richer man? The guy who makes $100,000 a year working 60 hours a week, or is it the man who makes $60,000 a year working 10 hours a week from anywhere? Right? I mean, key question. But think about it in terms of your trading. What would you prefer to be? Would you prefer to be spending 6 hours a day making 10% a month, or spend an hour a day making 6 to 8% a month? Could you sacrifice a bit of profit to spend a tenth of the time? Right? So that's the question I challenge you, and that's the beauty of scans. Yes, you might miss a couple of trades, but what I've always found is by having proper scans is you generally find the really good ones in the first 5-10 minutes. That's my stapler. Yeah, someone's seen The Office. Okay, so let's push forward. So this is obviously what I'm getting at. When you know what to look for, you can scan for it. Okay, a business partner once said to me, if you ever do the same thing more than once, you can develop a program to do it for you, and the same certainly applies for trading. Right? Once you know what you're looking for, when you know exactly, go back to that image of the baby with the crayon, when you know exactly what you want to draw, what the bottom looks like, what the smart money's fingerprint is, you can design technology to help you find it. You can't analyze 8,000 stocks a day. You can't even analyze the 500 predictable stocks a day, day to day, not for short-term trades. You could for long-term investments. For your longer-term holds and your fundamental buys, absolutely. But for your short-term trades, you need to be on the money, because a short-term trade could be great today and a sell tomorrow. You need to know the moment it happens, and that's what scans are for. So you can spot the exact entry price, exit price, and finish your work quickly to go on with whatever you want to do in your life. Okay? And that's what this is all about. It's about being accurate, it's about being precise, but it's more importantly about combining both to be consistent. Okay? So we'll get to the, I'm looking forward to covering some of the live stuff tonight. I've been good on my time. I usually speak far longer. But yeah, let's talk about what's happening now. So going forward, January through May provide perfect trading conditions. I agree with Ross. I think that we've got a very interesting trading climate going forward. The first day of January in the trading world was a down day. That generally sets the tone for the rest of the month. It's called open range trading, and it's very, very valuable. In fact, it's predicted a high majority of the turning points in the market over the last 12 months. So January is so far in negative territory. 2014 could be similar, but either or, it's going to be very volatile. This is going to be a great opportunity for success. We're doing a 2-hour workshop. We're doing specializing in what we've just discussed, looking at high probability, profitability, and predictability scans. I could teach you hundreds of scans, but really what you need to know is what are the ones that work, basically. And what are the ones that work well enough and easily enough that you can start using immediately, so you can start practicing them in these current conditions. This is something that we've actually got running a few times. The first one is actually today, January 9th at 8 p.m. Eastern. And we've also got upcoming dates later in the month. So basically what you'll learn here is we're going to be doing a 2-hour workshop where we really hone in, as you might be able to tell about me, I really believe in the why. I don't believe in giving you magic formulas and black box stuff. And we'll give that too, but the important thing is you understand why. So what we do in this workshop is create a very solid fundamental understanding of how to build a scan, how to think in terms of reverse engineering how the market actually works through to creating a scan that works. Okay, so for example, one of the scans we created on the fly in the last group we did in December is we created a scan looking for longs by searching for stocks with high short floats, stocks that were extremely highly shorted that were reaching smart money buy zones. Now, you remember Ross mentioned two stocks that I told him about when I met with him in Vegas at the Traders Convention. One of those was SNTA, and that was something we'll bring up here in a second, but it was reaching a smart money buy zone. At the same time, the insiders picked up millions of bucks worth of their own stock, and the stock was 66% shorted. That came up in our scan, and the one that we would be teaching you, one of the ones, and it consequently shot up. I think the price it went up for, just to bring up my chart here, I'll bring this up in front of you in a second. SNTA, so yeah, so this went up from $3.85 to $5.50 in 1, 2, 3, 4 days. Because when something is shorted so heavily, it has these massive short covering rallies. So thinking contrarian. We'll be talking about how to identify the smart money. So no matter what scan you're using, whether it's flags, whether it's reversals, the key thing we want to teach you is how to identify the smart money. And there's two ways you're going to use it. You're going to be using it to identify stocks that are about to reverse. Okay? And that's where, at the second point, let's call it point B, you want to see the smart money selling the hell out of it compared to point A. That's the contrarian trade, looking short stocks that are rallying where the smart money is getting out. The other way you're going to use it, and the other way we'll teach you to use the smart money, is being able to actually look for stocks where it's going in the same direction, where it's about to potentially break out and the smart money is loading up. Okay, a couple of questions. Is this workshop only focused on stocks or Forex too? No, this is something you can use. I've used it in options, Forex, and stocks. It's something that took me the better part of the first 6 years of I've been trading for 12 years. It took about 6 years for me to figure this stuff out. And since then, I've used it in all markets, and it is very effective. What platform do you need for your scans to work properly? You can actually use it. I've used it in Metastock, Incredible Charts, TC2000. We're currently getting specific extras developed with TradeStation and Think or Swim. Really, this focuses on the fundamental things that run the market. The class will be recorded, so you will get a copy of that, absolutely. In case you're obviously enjoying all the other speakers today when the live workshop is on, we'll actually be rerunning the workshop on the 30th of January. At the same time, so just a couple of weeks from now, and you'll also get an invite to that. Okay, because we understand that a lot of people might not be able to make it today, but if not, you will get the recording and you will be invited to the session on the 30th and be able to take part in the live session as well. So you can watch the recording and already come to that session well prepared with some questions and so forth. Able to scan in TradeStation? Yeah, I mean, TradeStation is a fantastic tool, and it has all the indicators that you'll need to set the scan up. We'll be teaching you a couple of scans as well. So not only will we be teaching you the tools we use, but what I also want you to be able to leave with is a mindset and a toolkit so you can go out and create your own ideas. So you can say, hey, I've got this cool idea. How would I turn that into a trading plan? I want to give you those tools so if I get hit by a bus, God forbid, tomorrow, it doesn't affect the value you can take from this workshop. Okay, let's have a look. Mike, does it work in Think or Swim? Yes. Yep, exactly. It does. You just jump on the phone. We'll show you how to set it up. You just got to plug the different variables in. We'll give you all the variables you need to put into your scanner, and you can scan right away. Now no, you don't have to buy any proprietary indicators. And just remember, we will be giving you specific scans. These are things you're going to be able to use immediately. So, ideas like, for example, the short float scan, looking for companies that have the heavy short floats, approaching smart money buy areas. I'll be showing you for the option traders out there, I'll be showing you how to find some very explosive trades which only works during earnings season. It's a strategy I developed last year. It's worked extremely well. We've had double-digit to triple-digit returns on those trades. We generally only find about 4 or 5 each earnings season that meet the criteria, so you don't get a lot of trades from it, but it finds a very small handful that work really, really well. And I'll be showing you how to set that scan up as well. So I'll be giving you quite a few different things that everyone's going to be able to take away and build from. So yes, it's not just going to be one thing or one proprietary indicator. It's going to be a toolkit as well. Can you utilize these techniques on the futures market? Absolutely. One of the guys I work with is purely a Forex trader. This is one of the first things that he looks at. Class is January 9th. That's today at 8 p.m. Eastern. And then the second session, which will be a duplicate, will be January 30th at 8 p.m. Eastern. Let's just have a quick look here. All right, so day trading, how your scanning process works on day trading. Works very well. The thing is, remember that market moves between levels. So quite frankly, I don't really care so much about time frames because the algorithms don't. Algorithms don't care what time of the day it is. They don't care, whether it's a long weekend. All they care about is what price was hit and when, and they buy. So instead of thinking of days, think of it in terms of price. So if I see a good trade that I think is going to go from $10 to $10.70, I'll be eyeing that up as it comes down from 11, and let's say it's hit 10.20 or something. I'll throw my buy limit order in for say $10 to 10.07. Now if that hits the next morning and sells half an hour later for 5% profit, great. If it takes 3 days, that's fine too. I'm not so worried about the time. Is daily time frame scans or hourly time frame scans to pick up the sessions. How long does the session go? Session goes from about an hour and a half to 2 hours, and then I stick around for as long as it takes for questions. I analyze live stocks. I'll talk to you about the stocks we're trading right now. Last time we had a group of guys who stuck around asking questions for a good 30, 40, 50 minutes afterwards. So we usually clear a wide berth at the end of the workshop to get all those questions answered. Yeah, look, I mean, you will get a lot of value about it. It's $29, but look, it's the brainchild of what took me the better part of 10 years to really realize, to get rid of all those old habits that took a long time to die. So for $29, look, I'd be very surprised if you didn't find you got a great deal of value out of it. I'll be showing you how to build scans to pick up stocks like ETRM, flag formations. And look, if you don't get the value out of the $29, you email me and I'll refund it to you. We've done this 4 times now. I haven't had to refund a single person yet. It's an old saying, under promise and over deliver. So let's have a look at some of the more questions, and then we'll switch over to the live stocks. How long can you utilize these techniques in futures? Yes. Are there free internet sites that can perform scans? Sure, absolutely. In fact, we'll be teaching you those. I'll be giving you access to 3 different free online tools that you can use on an ongoing basis without paying anything, and these will be enough to run all the scans, or at least some of the core scans that we use. If you want to get really intricate, you do have to, but that's not necessary. So we will be giving you free tools that you can go away and use immediately. and we show you how to create some fairly intricate scans with FinViz, incredible charts, a couple of the other free scanning sites showing you how to set those up exactly. Will the class be recorded? Absolutely. Same price for the 30th. We are limiting it to 100 registrants. The 30th is actually an overflow because we did have a lot of people register who weren't able to attend, so we put the second one on to allow people to redo the class if they wanted to. We usually do that. So you would be getting both the classes for the $29. But that does get limited to the 100 registrants because that's the room size that we do use, and it does sell out very quickly. We did one, as I said, in December, and we were full within about 24 hours, which is why we've opened up the second room this time. So I recommend jumping on it. Which platform does Acorn work with? I use Interactive Brokers. The other traders I work with Sterling and Thinkorswim. But we don't use those platforms to scan. I use independent programs to scan. I work evenings and cannot attend at 8 p.m. No problem. If you can't attend the live session, you can attend the recording. And if we do have a trial, you can spend $9 to trial our trading room out if you like. That gives you a full month of gold access, and that gives you full support from our coaching team. So for $9, you can call in and spend a half hour with one of our junior coaches and have all your questions answered if you like as well. So if you can't attend live, there's a really good workaround for you. What do these scanners work on? Excuse me. TradeStation? No. They work with a lot of the platforms because all these platforms where you see these fancy techniques, and they are fancy because we have some we've designed ourselves that we haven't released yet to the public. We're still fine-tuning them, and because of the amount of money we put into them, we're protecting some of the code. So I do understand why people do that, but just remember that all these fancy things are different ways to look at exactly what you see on every single chart in every single program. There's only three things: price, volume, and time. Everything else is a function of those three things. So if you understand how to read, again, remember what I said earlier? Forget the fancy terms. If you understand the basics of what fundamentally moves something and where it turns and how and by who, you don't need a lot of that fancy stuff. You could trade just using candlesticks and a chart. Yes, there is a special rate on the trading room. That's the $9 exactly. Yeah, if you want to buy the scanner, you can on its own. And if you want to some of our scanners, yep. Special rate for the trading room, yep, it's $9. $9 for the trading room. Again, we don't believe in tricking people into working with us. We've had a great run of 7 years now doing business the way we do, and it's all based on building long-term relationships. Do you have webinars for the European trading hours? Yes, we do. Mark, with the Thinkorswim data, we actually talked to them today, so we should have the. There's if you actually check, anybody who's registered, you'll actually be getting an email today with an hour video of how to set up the scan in any trading platform with all the different criteria listed. So anyone who's got a different program will be able to set that up as of today. It's okay. Have a look. We have two developers currently also developing a specialized scan for NinjaTrader and TradeStation, which has been under development for the last 2 weeks, just upgrading one of our existing program scans. So that'll also come out next week. But these are all specialized packages that will just make it easy for you to use by clicking one button. but you will have a video that we released today that shows you how to set it up manually in any program in case it's not one we support. Okay, I'm going to flip over to some questions. We've got a few minutes left here. And yes, those are all included. Those are all included. So everything we've talked about is all included in that class. They're not extras or anything like that. If you're needing questions answered, you can also just email us here at info@Acorn Wealth Corp regarding the trading room and so forth. So let's see if I can show you a couple of examples here. Okay. Scans are always forward-looking. We don't. I used to trade a lot of momentum. Mike, I used to trade looking at the stuff that everyone's been taught to use. You know, moving averages and all that kind of thing. But problem is that a lot of the time, once that's already happened, the trade's already happened. So it's not very useful. So right now, what I'm looking for is I'm looking for trades that are about to happen. So in an extremes trade, I'm looking for a stock that's plummeting, and I'm looking for the level that could be 10% away to find that entry point. So I'm just going to bring up a charting program here. So I see a question regarding Metastock. Yes, we do have we have a module for Metastock where we plugged all of the indicators we use into one module, and that is also included. Let's have a look. Okay, can everyone see this chart? Awesome. Let me show you real quick. Just going to show you something here. If I can get this screen sharing to work. Okay. So this is actually one of the stocks that we mentioned before. SNTA should be popping up. It's a couple of examples of how smart money well. So SNTA, here's a stock we were chatting about. This is the one I mentioned to Ross in Vegas. This was coming straight down, you can see, to this zone. The short interest right there on that second right line, if everyone can see that. Can everyone see that now? It doesn't look like that's working. Hang on. Okay. Doesn't look like it's working too well. I'll try to refresh. But SNTA was one. A couple of other ones. Apple. Who's trading Apple recently? Apple was a great example of where it hit a double top recently. Okay. You saw Apple going up. It reached a double top. And then as it hit the double top, the smart money was flowing right out. So flowing right out. So when you see that divergence, I'm just trying to load it up, guys. For some reason, the desktop sharing program isn't working as reliably as it should. Just give me a moment, though. It's trying to load. But Apple goes up, hits a double top, and smart money was trading out, which was a key indicator for a potential short on that trade. Okay, a couple of other ones. ETRM, Okay, can everyone see the chart now? All right, so okay, great. So here's Apple. This is one of the images. This is one of the the techniques we use. Money flow, one of the indicators of smart money that goes into our algorithm. One of the things you'll be learning in the workshop. This is one called Twig's money flow. So have a look at this. There you go. You run up, hits the top, comes back down, hits the bottom. Look at these levels. Look at these levels. Let's play this one out. Here you go. Up, creates an inverse head and shoulders. Inverse head and shoulders, you measure, replicate. Where does the head and shoulders take you to? 540. Rallies up to 540. That's the new level. Breaks through, creates a top. Creates a double top, lower high, money flow going out. So even though the stock is at a much higher level, money flow is diverging out. Smart money is selling, and there's your short, right there. Look at the two differences. Look at the two differences. There you go. Lower high and money flow significantly less, perfect short. Okay, let's look at TKC. This is actually one of the picks from the students of the last scanning class. One of the first picks they did. I'm not sure if Jeremy used real money or paper money, but he emailed this one to me. Again, smart money trade. Stock plummeting down. He picked this the day before, on to Thursday, December 26th, before just after Christmas, and told me he put an order in there just below $13 and a sell at $13.60. Look at that. One day, bang bang, straight up. Don't even have to be there to watch it. That's one of those things where you look at it at the end of the day and you see it's exited out, and there's again, not being greedy, in and out before it hits the next level. TKC, and again, you can see that smart money really plowing out, or one of the indicators anyway. Let's have a look though at some of the. I'll show you the same kind of setup mimicked over in Metastock. And this is where you can, this is an example on, say, BlackBerry. Okay, BlackBerry got up on the screen already. So have a look here. This is just simplified, so all the different indicators simplified into a signal. So have a look at BlackBerry. This is where you can make really exciting option trades. We call the short through puts on BlackBerry on the 25th of June, right there where I'm pointing at. Up, down, up, down, up, down. Consolidation, right? Wrong. Yeah, it's consolidating, but what is consolidation? Consolidation is an opportunity for the smart money to build a position every time it drops to the lower side, or to get rid of a position every time it goes to the higher side. Okay? Reaches a point. And as you can see, this whole way through consolidation, bearish smart money, bearish price action, plummet. Now have a look over to the right.
Hey, John, I'm not sure if you can hear me, but we're only seeing a gray screen. We're not seeing your chart.
See, okay, 1 second. See if we've got this here. How's that? You got that now?
We see BlackBerry now. Yep, we can see.
Perfect. Here we go, guys. So there's the chart I was talking about. You can see this consolidation, consolidation, consolidation. Comes to a point, and the whole time, smart money bearish. And right there, where I'm pointing, that was where we called a short. Those options, those puts, have gone up extremely, it went up extremely, I think over 1,000% overnight there. This is a daily chart. Now look at the same type of thing on, so we go to the right-hand side. You can see what's changed now. that smart money, or the money flow, has now gone back in. Twig's money flow is one of the things that goes into the calculation, but we also build into it divergence and a couple of other things, including RSI, CCI, and so forth. And we have some specific combinations of those that really put the power together, which is what we'll be teaching you in the workshop. So as you can see here, Facebook gone bullish, BlackBerry gone bullish over here on the 19th of December, and a big rally since then, up from just above $6 to now closing at $8.45. So look at this same consolidation pattern. Let's apply it to Facebook. And we've only got a couple of minutes left here, guys. But let's look at Facebook. You can see the very similar thing. Very similar thing here as Facebook consolidated through the 2nd of May. Excuse me, the beginning of January through to the 2nd of May. Consolidation, all the way down to this point here. And if you actually get rid of this and have a look at this trend line I've got drawn on, this blue line, the second it broke through that trend line is where the smart money went bullish. And from there, as a speculative long, different from the direction of BlackBerry, a very interesting profit potential there. So guys, this is just the tip of the iceberg. It's hard to I could be talking for hours longer to show you all the types of things that we'll be covering, but the final thing I'll quickly bring up on the chart for you, ETRM. This is the other type. This is where we're looking for flag formations, and this is the other thing we'll be teaching. This is actually one of the stocks that came up in a scan just recently. And there you go. That was ETRM. We actually found that as a long. Hit our long criteria at $1.70, and we had a sell criteria at $2.47. And you can see what that's done recently. That came up in the scan that you'll also be learning in the workshop. So guys, I hope you've enjoyed that. We'll be getting the recording out to you immediately after we finish this afternoon. Again, $29. If you don't get value out of it, you watch the recording tonight and it was useless, you email me tomorrow and we'll refund it to you. You'd be the first person, and I'd be happy to do it. But guys, I hope that's been valuable for you, and thank you so much for your time.
All right, great. Thanks, John. We appreciate you being here. And again, guys, here's the here's the link one more time for you for the $29 workshop, and everyone will receive a recording of that workshop. I'll type it in here as well. So again, we appreciate you guys being here. Off to a great start with the Trade-A-Thon. We had Ross Givens, followed by John Seville. Now we have a good friend of mine, Jeff Smith. I can tell you Jeff's actually one of the guys that helped teach me to trade, so I'm looking forward to hearing what he has to say about